Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, after considerably subdued growth in the past year, metals seem to be regaining momentum in 2024 so far. The gold prices globally have been holding steady ahead of the US Fed meeting, while prices in India are up 6% so far. Silver and nickel are grabbing the limelight, with prices growing at an 8.5% to 10% respectively in the past month. Also, copper prices are hovering at an 11-month highs on LME and an all-time highs in China. To discuss what factors are contributing to this growth in metals and what lies ahead in 2024, we are now joined by Hansen. He's Head of Commodity Strategy at Saxo Bank, and Goel is Global Head of Market Analytics at Marex. Gentlemen, hi, thank you so much for joining us. And I'll start with you. It's all about copper, isn't it? After being subdued for such a long time and not getting any impact from all the kind of growth that we saw in EVs or batteries for that matter, copper suddenly has seen this surge up, and a phenomenal one at that. How are you reading it?
Well, good afternoon, Manisha. I'm reading it as the market starting to adjust their expectations. As simply we're seeing the supply of copper starting to tighten. We have already earlier this year and last year seen mining companies announce production cuts, and that will eventually filter through to prices and the availability of supply. And we've seen that in China now during the past months, where these treatment charges had hit rock bottom simply because smelters are competing for ore material to refine, and that's driven down prices. So now they are potentially lowering their production, which would lead to even a tighter market. So we're starting to show signs of momentum here. We've broken the downtrend from the 2022 high. Whether we need a rate cut cycle to begin in the US really in earnest for this to move higher is probably the next big question, because we did see destocking from industries last year. That will start probably to reverse as funding cost starts to come down. But the timing of that funding cost drop is still obviously very uncertain given the signals from the FOMC recently.
But all the markets believe that the funding cost will come down, if not in June, then perhaps August or September, and definitely more so in 2025. So would you say that it is a given, not perhaps in the very near term, but slightly longer term, that we will see that happen?
We will see it happen, and simply in order to ensure that we have the copper that's required for the electrification of the world, the price needs to be at a level that mining companies feel incentivized to increase production. And we all know that you cannot dig a hole and drag copper out overnight. It takes many years. So we are potentially facing a number of years where we will see very tight market conditions, and that will underpin pin prices. And we're also seeing that in the investor space. Copper, just like many other metals, have been sideways trading for a while. Speculators has been trading copper from a almost a neutral basis most of the time with a small short, but now they're starting to respond and getting back onto the long side. So just in the short term, it may just be a little bit challenged by a lot of recently established longs, just like we're seeing in gold. But over time, we're still seeing copper prices moving higher.
Okay. I would also want to understand on what kind of an upside are you expecting from here? Is it going to be a 5 to 7, an 8 to 10% for copper, aluminum, zinc, nickel, tin? Almost everything seems to be trading firm.
That's true. I primarily focus on copper, and with the LME price at the next big level is when we eventually do take out the highs, then the record highs, and then I think we will move towards that $10,000 level on LME copper. That's the target for now.
Guy, what's your sense? Getting you in the conversation as well, and the metal prices really seem to be doing well. I mean, the last 1 week has been phenomenal, and we've seen newer ranges come into place. How is it looking on charts, and what would your strategy be?
Yeah, I think it reflects what we've seen over the last couple of years, which is really across many commodities, destocking throughout the supply chain. So prices are now a lot more sensitive to short-term changes in supply and demand. And recently, we've had some announced supply disruptions in copper, which in an environment of almost no sort of available stocks means obviously you get that sort of sharp price reaction. I think it's also important to recognize that despite the fact we've actually been in a fairly weak demand environment, particularly coming out of China over the past 12 months or so, the lows in copper were $8,000, not $4,000 if you go back a few years. So I think it's clear that there's a new floor, I think, in a lot of commodity prices, that the inflation that we've seen come through has sort of established itself as sort of really structurally new levels for base metals. And I think whilst they tend to sort of go up in stages rather than just all in one go, I think certainly the medium-term outlook for base metals is very positive.
Guy, while of course we do continue to watch fundamentals here, but there's a lot of hot money or the fund money which has started to pour into metals. How are you looking at this inflow, and what are your targets for many of these metals?
Yeah, I mean, I think it's fair to say that probably if you go back to the beginning of last year, maybe there was certainly a lot of speculative capital looking to get long of copper, which proved to be mistimed, as it were. And we spent the last 9 months or so in most base metals effectively going sideways. So I think at the moment if there are speculative positions there, it's relatively early stages, and certainly we haven't seen extreme positioning building up. So I think, to be honest, I think in the short term, I'd be a little bit cautious because we've just had a sort of number of supply disruption announcements. If you saw more sort of demand-driven movements in price, I think that'd be much more sustainable. I think that you look at the difference in copper and say iron ore, I think which is indicative of what's going on in China. China's rebalancing its economy away from investment-led GDP towards consumption-led GDP. So, it's still going to have to navigate that, trying to stimulate retail demand while sort of trying to make sure that the property bubble doesn't burst too problematically. And that's obviously a difficult challenge. But yes, we've seen $10,000 copper in recent times. There's not really any reason to think it can't regain those highs.
All right. You mentioned about iron ore, Guy, and well, absolutely, it's a tale of two different cities when you look at the ferrous and the non-ferrous metals there. In the last 1 month itself, we've seen the copper prices gain up by 8%, while iron ore is down 19% in the same time.
Yeah, and I think it, again, reflects what I was mentioning around destocking of supply chains, and that prices can be very sensitive to the short-term factors more so than the medium-term factors at this point. Everyone knows there's a serious problem in Chinese property. There's too much debt. There's massive oversupply. The challenge will be for the authorities and how they allow that to deflate. It's very unlikely, in my opinion, that will just naturally happen without some sort of central intervention. That's pretty much been the case in other very similar situations we've seen either in the Western world or indeed in say, Dubai back in, say, 2008. And at some point, I think the authorities will have to step in and probably protect the deposits put down by retail customers, which is going to likely to be the point at which they deem the problem to be too serious. How they deal with some of the sort of bankruptcy or haircuts on some of the debt is a different matter. But yeah, it's very, very different drivers. Copper's got much more positive demand supply story over the next few years because of the whole electrification of vehicles, which iron ore doesn't have.
Oh, absolutely. And there are various reports, guys, suggesting that the iron ore prices could be heading to $100 or below. Would you also belong to that camp?
Yeah, so I think the history of iron ore is that, it can, in the short term, it can go very low and it can go very high because it's an expensive commodity to store when interest rates are what they are. It's a bulk commodity, so you need a lot of space to store not a lot of nominal value. So yes, it is definitely a market which can be in sort of extreme surplus or indeed extreme deficit, actually within remarkably sort of close periods of time. And it's very dangerous, in my opinion, iron ore to sort of fight the trend because the trends can be quite extensive.
All right, that's about the industrial metals, and let's put focus on the precious metals as well, which have done quite extremely well in this year until now. How would you look at gold? All-time highs done with higher targets in sight now is what various banks and brokerages seem to be putting out. What is your sense on the first half of this year and the second half of this year when you're looking at gold?
I think it's too much too soon, simply because the underlying the docs have not been lined up in a row yet. I think they're still running all over the place. We do have strong physical demand. Yes, we do have a technical breakout attracting an immense amount of speculative buying. It's mind-boggling that in the last 2 weeks up until last Tuesday, hedge funds bought 284 tons of gold. That's basically what ETF investors spent the previous 7 months selling. So that is my short-term concern, that there's a lot of recently established longs coming into the market. Speculators are not married to the position. They will seek a divorce if things go south, and that basically is my short-term concern. But the long-term picture, this is in line with what we expect. Just the timing is slightly off in our view, but still looking for gold moving towards the $2,300 level, as funding cost, as interest rate starts to come down, as ETF investors potentially start to return to the yellow metal, as funding cost and the cost of carry comes down as well. That could be the next stage, but just in the short term, we're faced with I think with quite a bit of nervous trading, simply because there are some major stops not a million miles below the market, and we need to avoid getting close to those, and that will obviously depend to a certain extent on incoming data from the US, but also what kind of signal we get from the FOMC tomorrow.
Oh, well, absolutely. And Guy, how would you look at the silver prices from here on, and what's your sense also on the dollar index moving on?
Yeah, no, I'd certainly echo his comments on gold, which a lot of which can apply to silver as well, as another precious metal. I think that you've had a lot of tailwinds for gold recently, both on the demand side, but I think certainly for both gold and silver, probably the key risk is the dollar going forward, in that we had quite a significant decline in the dollar index on expectations of the US being the first to cut rates. Obviously, we've got a Fed meeting later this week, but I think realistically, it looks like inflation's proving too sticky and growth is actually too good to realistically expect the Fed to come out and be exceptionally dovish. I think things need to either get a lot worse in terms of the growth environment, or significantly better on the inflation environment to think that we're going to see a rate cutting cycle that's material. I mean, you might get a rate cut here or there in the second half of the year, but we're not talking about halving the rates that we currently see. So I think the risk probably is that the sort of the end of dollar weakness that we've seen recently, and dollar index continues to climb. That's going to hold things back. Having said that, silver again has a phenomenal underlying demand story, really coming from the build out of solar. But again, in the short term, that's looking a bit more challenged. Not least because prices have risen to such a point that solar manufacturers are starting to sort of cut back output. But so yeah, in the short term, probably not a great risk reward for longs.
All right. So, well, yes, there's so much happening in the international markets and so many uncertainties there. But yes, some of these metals definitely have an upside. And as you both mentioned, that copper and gold perhaps are the places to bet on the longer side here. Guy and Ol, thank you so much, gentlemen, for joining us. It's always a pleasure listening to you and your insights into that space. And with that, we'll take a short break, but don't go anywhere, because coming up is a discussion on the outlook for metals from an Indian perspective with Dhruv Goel of BigMint. Be right back. Welcome back. You're watching Commodity Champions. We are now joined by Dhruv Goel. He's CEO at BigMint. Dhruv, hi, thank you so much for joining us. And we've had a whole discussion on non-ferrous metals and precious metals, where the markets are kind of bullish on. But it is really about the ferrous metals where the global prices have continued to decline. I'll start with the iron ore prices, because in the last 1 month, we've seen 19% of a decline in the global space. How relative is it that to the Indian markets? What's the kind of impact that you see happen here?
First of all, thank you, Manisha, for having me here. And on the contrary, how non-ferrous market is performing, the ferrous market is exactly opposite. And as you mentioned, the iron ore prices, which have corrected 19% in last 1 month. And to answer your question that what is the relevance in the Indian market, although it does not have direct relevance because India does not import a lot of iron ore, but yes, because India is a major, one of the large exporter of iron ore, so it has reduced the export volumes. And also it has have some bearing on the prices as well.
What's your sense going forward from here when it comes to the Indian demand itself?
So overall, although this quarter, your Jan to March, is supposed to be a very good quarter from a demand perspective conventionally, but because of election and other factors, this quarter has not been very good for Indian steel sector. What we understand from the market that there is some production cuts being taken at the large mills and at the smaller mills. So that has also reduced the appetite for iron ore in the domestic market.
India is supposed to be a very strong story going forward with the kind of infrastructure and development that we foresee and that is in progress, really. What's your sense on the overall steel production and demand going forward for this year now for India?
You're very right that India is a very, it's a very bright spot and the growth story is good. Although if you specifically talk from this year's perspective, so we expect that this year will be relatively tougher for Indian steel sector compared to what the margins, the production or the demand they have observed in last 1 or 2 years. So this year it will be, tough in all the parameters because there are quite a lot of supplies which are in the system and demand probably will not be pacing up at the same level what it was a couple of years back. So overall a tough period for the industry.
And how would you look at the prices for the Indian markets itself? I mean, we've seen the global steel prices hit a 4-year lows and then see some correction on the higher side. The Indian markets have clearly reacted to that, even if on a sentiment basis.
You're right. There has been a correction in the prices, consistent correction in prices, both longs and flats. Although longs have come to a level wherein we see there's some kind of bottoming out, but flats there is certain scope of correction going forward, as in the export, because India is their 8% of their production is dependent on exports. And because the other markets are not doing good, so that exports are being impacted, as well as the global prices, especially China and other Southeast Asian regions, the prices are low. So that is a big challenge for Indian steel industry.
Dhruv, you mentioned that for this year in India, our own consumption is going to be an issue as well. Of course, the global prices are weak. The exports are not picking up, as you said. The Indian domestic markets could be hit as well in sense of our own consumption. But when do you see the Indian markets improve going forward?
So at least, because we have elections from April to June, so we do not expect a lot of activities to take place during this period. And after it will be followed by monsoon. So typically, if the demand has to come at a better pace, it will be after maybe September, October.
Though also going forward, the Chinese data has started to come in slightly on the positive side. The dollar index seems to be doing well as well. So when you look at the global cues, where is it that you have your sight on? Is it going to be about the interest rate cuts? It's going to be about Chinese data getting better? What are you watching?
Although Chinese data, whatever data is being reported by Chinese authorities are better, but on the ground, the situation is not very good. People are still bearish. The mills in China have produced more. If you see their inventory numbers, it is higher by 8 to 10% in Feb end compared to March first week. So the overall situation on the ground is not very good. In fact, that has also resulted in a very steep fall in your spot and future prices. Export prices would be anywhere between 520, 530 FOB levels, which used to be at 550, 560 levels a couple of months back.
And Dhruv, when it comes to prices, how connected or disconnected are we from the international markets? I mean, are we trading at a premium right now?
Yes, we are at a premium of, in case if imports have to come, it will be cheaper by at least 2,000 to 2,500 rupees per ton. Although because of certain restrictions being imposed by the government, not direct barrier, but indirect trade barriers like the BIS licenses are not getting renewed. But if imports have to come, it will be cheaper by at least 2,000 to 2,500 rupees per ton. And on the other hand, Indian exports will be expensive by at least $30 compared to Chinese and Southeast Asian mills.
So it does look like a tough time right now when it comes to the ferrous part of the industry in the Indian markets. So what's your sense going on margins for many of these? Do you see a tough period for many of these producers?
Certainly, yes, it will be a tough period next quarter, this quarter, and at least till June, it looks to be a tough period for the Indian steel industry, be it a large mill or a small mill. But yes, maybe because the correction in raw material prices like coking coal, and we expect that iron ore prices may also correct. So that will maybe give some cushion to the mills. But yeah, overall, if you have to compare it with previous quarters or last year, it will be definitely down.
Dhruv, a final question. So what's your sense on prices going forward when it comes to steel or iron ore for that matter? Would you say that the correction is done? Or as I was talking to Guy and he said, yes, $100 a ton of iron ore in the global markets is a possibility. Would that impact Indian markets? Do you see further price declines? I mean, you've mentioned all the negative points really for the next couple of quarters at least. Would that mean further pressure on prices?
I think there's definitely, market is expecting a price correction, at least in the flat segment. So, market is expecting anywhere between 2,000 to 2,500 rupees correction probably in next 1 to 2 months. Longs look relatively stable, but yeah, because maybe during election, not many government projects are likely to get awarded. So longs may also get under pressure, but it will be after May. But immediately the price correction is expected in flats, what markets are expecting.
All right. So as far as the ferrous metals go, well, the international markets are weak on various levels and the Indian markets have their own things to deal with. It's going to be elections and then monsoons and not too many government projects will be awarded. So everywhere that you look, there is some more correction, some more pressure that we can expect on this sector. Dhruv, as always, thank you so much for joining us with your sense on that. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.